Hello and welcome back. I'm excited to be joined by Anne Arlinghaus today. Anne is partner and co-head of KKR's Capstone team in the Americas. Anne is at the heart of how KKR creates value beyond capital, working hand in hand with the portfolio company, with the teams at the portfolio companies to unlock growth, drive operational excellence, and ultimately embed a people-first mindset into the day-to-day execution. She's been with the firm since 2008 and brings not just experience, but a real passion for making businesses better. And let me add, in addition, she recently took time out to write a guest comment for Mastering Private Equity, for which I'm incredibly grateful. And thanks very much for making time.
Thanks so much for having me, Claudia. It's great to be here.
So let's start off. And in your contribution to Mastering Private Equity, you describe how the value creation playbook has shifted in private equity from leverage and multiple arbitrage to execution and EBITDA growth. So with that in mind, let's start with the first question. What has changed the most in the way top private equity firms approach operational value creation today?
Well, as you say, the sources of value creation in private equity have shifted over the last several decades. Everyone in the market really has the same access to financing. And so, driving value creation through financial engineering is sort of table stakes in terms of how firms invest. You also, as the markets have shown us over the last several years, you really can't rely on multiple expansion to drive a great exit. And so what you need to do is really have things that you can more or less have in your control when you're looking at investments to make, which is really around how do you find good businesses that you can help make great. And that's really what we focus on here at KKR. Increasingly, I think firms like ours are becoming much more proactive and growth oriented in terms of how we think about value creation. And oftentimes having good cost, kind of discipline and efficiency is really a hygiene factor. And so we're really thinking about how do we help a company grow and take it, to the next level. I think that's also then shifted how teams like mine and how firms broadly think about value creation resources. And if I think about the Capstone team, we've been around for over 25 years as a part of KKR. Initially in the early 2000s, the team was really focused on kind of being reactive, getting pulled into situations and focusing time across the portfolio where there was an issue in a company. Over the course of the last several really decades, we've become much more proactive in terms of driving, really driving value creation even early on in the diligence process in terms of thinking about and helping our investment teams underwrite what we can do operationally with a business, and have also become really very much embedded into our investment teams. And so that dynamic puts operational value creation at kind of the center, the early stages of thinking about what to invest in.
Yeah. And I guess diligence is where the operational value creation process starts. So as you mentioned, not just once the deal is being done. And you wrote that operational value creation starts in diligence. Could you give us a sentence on what great looks like when you assess a potential portfolio company at the time, and when you assess operational levers during that process?
Yeah, sure. I think we really start thinking about writing the 100-day plan or the value creation plan early on during diligence. And so actually in a lot of our investment committee memos, we have a draft of what that plan is going to look like if we're successful in the process. So I think that orientation around not only what are the levers, but how will we actually go do it? How will we execute? What resources can we bring to bear to the company to help them accelerate or capture the opportunity? I think in terms of the diligence process itself, oftentimes you have less information than you would like to, but we really focus on being very data-driven in terms of assessing opportunities, whether that's company data that we have access to, understanding benchmarks and broader, industry data, and really trying to bring a fact base. The voice of the customer is incredibly important to understand and evaluate. And so we're really kind of bringing together, along with our investment team partners, that full mosaic of information about the company and what the opportunities are. And then when it's done really well, we're actually quantifying that and kind of identifying specific levers, whether it's, sales force effectiveness or pricing strategy or market expansion, an underpenetrated customer segment, kind of specific levers that we can then quantify. And where where we increasingly try to get to is to be able to quantify those in our valuation models and think about, are they appropriate to put in the base case or really an upside case? And so we're really looking for multiple value creation levers, because we know in a world where things change quickly and where you don't have perfect information during the diligence process, we know that not everything is going to play out the way that we model it out in a deal model. And so that's a really important part of the thinking is, are there multiple ways to win, and how much execution risk are we sort of taking on with each of these different opportunities? And that often comes back to assessing the talent in the business and the infrastructure and systems, the data quality, kind of like really understanding how capable the business is to execute on the opportunities that we're seeing. And when it's done well, it makes the kind of post-deal process really easy, because you've got then the plan ready to go, coming out of the diligence process.
Yeah. And obviously all this is done independent of how ultimately the deal is being financed, right? This has nothing to do with the financing structure. It's purely, can we basically get our head around making this company better in our ownership period?
Yeah, that's exactly right. It's really focusing on, obviously other levels, and we want to have, capital efficiency as well, but it's really, how are we growing EBITDA? How are we driving profitable growth for the business? Often trying to inflect that beyond a trajectory that they're already on, because that's really what our LPs, our investors, are paying us to do, is to identify those opportunities and help the teams and the portfolio companies effectuate them.
Yeah. Now, you mentioned in the article, you mentioned the idea of governance arbitrage. What does it look like in practice at KKR?
Yeah, I mean, what I meant by that comment was really that I think, a big part of the private equity model is really having the ability to align incentives across the investors and the management team in a very clear way, and to really have sort of active board governance, that is more focused on seeing those opportunities and helping a company achieve them, by driving for performance and growth, versus a mentality that is more focused on kind of risk and governance that's more focused on avoiding downside, which I think is oftentimes can be the case in more of a public company context, for sure. And so the governance arbitrage that I referred to is really this idea that by bringing the resources of a private equity investor, the sort of strategic thought partnership, and the active governance, that you can drive meaningful performance in a company. And a lot of that, to do that well, an operational mindset, I think, is really important, because we're not just looking to understand the financial performance that happened in the previous quarter. We really want to understand, are we on track, and are we building the growth engine that will drive financial performance in the quarters and years and so forth to come. And to do that, you have to really deeply understand the business, how the operational drivers and KPIs and metrics are kind of leading indicators of financial performance. And so we will get very much into that level of discussion, and making sure that we really have that kind of focus on the leading indicators of growth in a business.
And you're a big proponent of broad-based ownership. So not just management incentive packages, but ownership packages that are much broader, go much deeper into the company. What's the evidence that those programs actually change outcomes for you, for your LPs, and outcomes for the companies on the ground?
Yeah. I am a big proponent of these models. I think that, broad-based ownership is really the ultimate alignment of incentives, for all the reasons why the private equity industry has thought that it made a lot of sense to have these very aligned equity plans for management teams. Imagine if you extend that to the whole workforce and you're unlocking the human potential of the thousands of people who are working at a company and not just the top 10 or 15 executives. And so what we have been seeing in our portfolio companies has really been that the ownership programs are not only about sharing equity participation, but really about creating this culture of ownership that is very high performance and is such an incredible tool to get everyone rowing in the same direction, and really, kind of in small examples and big, creating opportunities for people to bring their whole selves and like their whole energy into a business and feel like they have a bigger purpose beyond just their own, sort of paycheck. And so there's kind of, you asked about evidence. There is, kind of high level analytics that we've done across our portfolio, and I can share a couple of data points. But there's also the sort of stories of how workers are showing up in their day-to-day differently because they feel like they have a stake in the outcome. At one of our program launches, the CEO also announced a sort of process change that was going to be rolled out across a number of their locations. And it was pretty disruptive and, not necessarily welcome to people. There's a lot of change management to do. And after the presentation, several employees at a site that wasn't picked for the pilot came up to the CEO and said, I get it. We want to be the second site. As soon as you're ready, come bring this to us because we want to be part of, making this better for everybody and rolling out this, this process change. Another example is really, companies across our portfolio that have created sort of systematic ways for frontline employees to share their ideas and effectuate them. And so you see these really great examples of what it means to have an ownership mindset in your company. And in many cases, for companies that are tracking this, it's real dollars. We've have companies who have tracked $20 million of margin improvement based on kind of these frontline ideas. A great example that I often share as an anecdote is at one of our companies, Charter Next Gen, which makes plastic cling films. One of the employees identified a small part in their manufacturing process that they were importing and buying from somewhere else, and it was expensive, $100 for the part. And he said, "This looks actually pretty simple." 3D printed it, and now that part is something that the company makes themselves, and a 3D printer, $3. And little examples like that adding up really drive change. And so there's a lot of those types of anecdotal examples. When I think about the evidence, at kind of a bigger picture level, I would say, our early exits, we've had 10 programs across the KKR portfolio where we've exited with an ownership program, and the returns in those deals have been quite good. They've been above our average returns. Early days, small numbers, but as we continue down the path with this, I think we'll continue to learn a lot more. And then more specific to the idea of leading indicators, most all of our companies that are implementing ownership see improvement in employee engagement scores, meaningful reduction in quit rates, so voluntary attrition, and improvements in safety outcomes. And so for 80% of our companies that have active programs, we've seen quit rates go down by a median of 30%. So meaningful change in terms of employees' engagement and desire to continue working there. So in terms of evidence, just to come back to the question, right, like it's early days in terms of really seeing how these models will perform across our portfolio and more broadly across the industry. But I'm really encouraged by both the anecdotes and the overall kind of macro trends that we're seeing, that it's driving real performance improvement for the companies, and then real wealth creation for the broad base of employees. We've paid out over 1.5 billion in payouts in the programs that we've exited to over 130,000 people, and the impact that can have on people's lives is incredible.
Yeah. And you're rolling this out now globally, as I can see. I think you started in the US. It started in the US mainly for your US investments, but it is now part of the global playbook. Is that correct?
Yeah, that's right. So we started, and really under the leadership of Pete Stavros and a lot of our industrials team, well over a decade ago in the U.S. industrials portfolio companies, and have kind of had so much conviction that it really works, that you can effectively grow the pie by sharing it. And so we've, as across our America's private equity platform, we're committed to rolling out broad-based ownership, everywhere that we have a control stake. And then outside of the U.S., it's the default model. There's a couple of different considerations, in terms of where we focus in different markets. But it is, I would say honestly, it is like core to our operational value creation playbook as a firm, is this idea of, we talked about the 100-day plan. As much as we're aligning the 100-day plan with the management team, we're also launching in every single one of our companies an ownership program, and then engaging the whole workforce in supporting that plan and that value creation agenda.
And tell me a bit more about KKR's work with Ownership Works. What have been, or what are the biggest learnings so far from this initiative particularly?
Yeah. So we, along with a number of GPs, were a founding partner to Ownership Works, which is a nonprofit that is really focused on essentially creating a movement around broad-based ownership in the PE industry and beyond. We think this is a core part of how the private equity model should work. And so we're really excited to support Ownership Works in that mission. And it's also been a really incredible opportunity to learn from others who are on similar journeys like us, in terms of how do you really drive change with these programs? How do you help workers get the most out of them? And so Ownership Works has a strong focus on, sort of helping companies both structure the plans, communicate the plans, drive employee engagement, and the business case that I've just articulated. And then Ownership Works also has a real focus on how do you use this wealth creation for a broad base of people, as a way to really help drive financial resiliency and tackle some meaningful societal problems. And so it's been an incredible partnership with the organization. I think in terms of learnings, the biggest one that I have is it's not a linear thing, right? It is building culture and really engaging human beings, because human beings are diverse and have a lot of different, contexts that they're coming from, is not a super simple linear journey. And so a number of our companies, and I think this is shared across across the Ownership Works community, are experimenting with kind of what techniques work, how do we really kind of drive engagement. And I think it also has reinforced for me that the kind of core principles of good problem solving, right? Make a plan, measure the outcome, assess the situation again, measure again, act measure again. That sort of core mindset around how you would drive change in an operational setting or otherwise really does apply to people and people metrics. So even though it's messy, we have tools that we can use to try to really drive outcomes.
Yeah. And I like their website as well. They're really good in sharing the stories, I think, to consistently basically put out different stories, not just from private equity investors, but in general across the industry. So now I want to shift over to sustainability and broader mandates. You've played a role in sustainability initiatives throughout your career in private equity. Where do you see those initiatives deliver the operational value and not just reporting on the measures, but actual real impact on the operations of companies?
Yeah, I think when it comes to sustainability, the sort of terminology in the space can mean so many different things and can be used really widely. When I think about sustainability and really certainly the approach that we at KKR have is to focus in on what is material and relevant for a business. And I think when you're doing that, when you're really focusing in on the issues and initiatives that are most relevant for a business, that's where you see the value creation really happening, which is not, probably rocket science, because obviously if something's just not relevant for a business, then it kind of does become a check the box reporting exercise. Where we've seen, meaningful value creation, meaningful impact, it's in situations like thinking about physical climate risk for businesses that have a meaningful portion of their manufacturing or other assets in a single location or a small number of locations that are at high risk. Where we've focused in on that and sort of thought about mitigation measures and so forth. That's an example that that really has resonated. In healthcare businesses, healthcare provider businesses, focusing in on patient outcomes. Like that's the core, sort of issue that is the reason for being for those organizations. And so, of course, when we really focus in on that, you create value, as a result. So for me, it's all about sort of relevance and materiality when it comes to sustainability.
So coming back to your experience in working with teams and trying to get them to basically work with you along the lines of the 100-day plans. You've obviously worked with dozens of management teams. So what separates the truly outstanding teams from the rest? So especially obviously in the kind of private equity context.
Yeah. I think there's a couple of characteristics that I'd say are a common thread. One is sort of the pace and desire to to sort of push hard and drive. And I think that teams who are pretty relaxed are often ones that just there's a mismatch. Like if you think about the board governance that I was talking about earlier, in terms of being more oriented towards reaching for the full potential of what a business can be. That's the orientation of management teams who I think are really successful in a private equity context. So, the kind of pace and just sort of clock speed of the organization. And then I think the alignment of that management team and their ability to align the rest of the organization around the vision is kind of like the other big ingredient. So, management teams that do well are ones that really like being together, that have a lot of trust, that have a great team dynamic, that aren't looking over each other's shoulders, but are supportive, really kind of work as an effective team. And a CEO who wants to hire top talent, like wants to have that team be all A players. And when that team of highly talented people are all rowing in the same direction, it's amazing, what can happen. And then I would say, and maybe coming back to the idea of the ownership culture, one of the real differentiators that we've start to see is the ability of that leadership team to bring the whole organization along and to really activate everybody. And that requires a different type of leadership. Command and control doesn't work very well if you're trying to really spark people's ideas and get them to feel safe about taking risks and innovating. And so there's a style of leadership that is more transparent, that's comfortable really sharing the performance of the business, explaining the vision, really investing the time to ensure that everybody understands that strategic vision and alignment, and really sort of leading with a degree of empathy where the leadership team is understanding and trying to connect with everyone across the organization. And so it's a mix. It's a very ambitious, high, fast-paced, leadership team and culture, combined with the ability to also bring people along and get people excited for that journey and wanting to, push to achieve the potential together.
Right. So this is really fantastic. So in closing, if you have one or two sentences that summarize the next frontier in operational value creation for private equity, what do you think it will be? So in the context of where we're sitting here right now in 2025.
Yeah, I mean, I think you can't talk about this in 2025 without acknowledging the incredible potential of AI, both generative AI and other types of AI and automation to really drive meaningful value creation. I think we are seeing really exciting use cases across the portfolio, and in different ways to help companies become more efficient and also imagine, sort of new products and services and how to connect with customers in different ways. I think one of the things that's particularly interesting is the way in which Gen AI kind of democratizes the ability to code. And I say this as a complete non-technologist, but the idea that somebody can, a sort of layperson can use, AI tools to do something that otherwise you used to have to get prioritized with your technology team and organization, and you had to go through a whole process of writing requirements, and that was very expensive. And so I think just the ability for people to access these tools to drive automation of workflows, analysis, and so forth, I think it's really exciting. It's also a space that's changing really quickly, and I think that that's almost the most exciting part about it, is this sense that even if the technology is sort of not there right now, if it's not actually good enough to really fully automate, whatever business process, the pace of change and improvement is so quick that you can start to, see a future where there's just a lot of possibility. So that's probably, I think, one of the next waves and something that we're spending a lot of time with our companies on.
Sure. So on that note, I really appreciate you making the time to join me. Thank you again for writing the guest comment for the book. So the copy is on the way to you and should have reached you. So thank you very much, Anne Arlinghaus, who is partner and co-head for KKR Capstone in the Americas. And next time on campus, okay? I see you soon. Thank you very much.
Sounds great. Thanks so much, Claudia. Have a great one.